Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in.
Okay, happy Tuesday everybody. The big news from the last 24 hours is the surprise decision by the People's Bank of China to hold its widely watched mortgage rate, raising market concerns over how China will tackle its ongoing property crisis. This could be a big deal, signaling a very different approach from Beijing, which could have significant implications for the wider Chinese economy. Today's video will look exclusively at this development and unpack the many different commentaries and views on what it could be signaling. On Monday, yesterday, the People's Bank of China, China's central bank, announced that the 5-year loan prime rate was to be left at 4.2%. Most economists had predicted the rate to be cut by 15 basis points following a similar reduction last week to a key central bank policy loan rate. The 1-year LPR was lowered by 10 basis points to 3.45% from 3.55%, also a smaller cut than most economists had predicted. For example, a survey of 35 economists by UK-based Reuters last week showed that all of them expected the central bank to reduce interest rates for 5-year loans as well as the 1-year loans. This has been a shock for many. Zhao Pengxing, senior China strategist at ANZ Bank, expressed at the news, quote, "This is a surprising result, showing the banks are not well prepared," end quote. Hui Shan, chief China economist at Goldman Sachs, expressed that the decision is, quote, "quite surprising and frankly, it's a bit puzzling," end quote. Indeed, just a few days ago, the American bank had voiced concern about the economy and the need for firm government support. Quote, "We believe the risk of systemic concerns emerging in China remains low. Those spreads will likely remain volatile until the macro volatility subsides. This may require a more concerted easing effort by China policymakers," end quote. Capital Economics, a London research firm, expressed in a note, quote, "This," that is the Monday People's Bank of China move, "will provide only modest support to credit growth and the wider economic activity," end quote. Economists at Citigroup downgraded their annual growth forecast for China to 4.7%, attributing the downgrade to, quote, "policy disappointment," end quote. Indeed, on Wall Street, only Bank of America and Goldman Sachs project growth in China of more than 5% for 2023. And Goldman's position is conditional, expressing this week, quote, "Our current assumption is that policymakers will ease real estate restrictions in first-tier cities and put more measures in place to support the property market in the coming weeks. But if it fails to materialize, we will have to rethink things," end quote. The market was disappointed with the Monday news too. Many investors, just like the economists we've just covered, had been expecting Beijing to act more decisively on interest rates as China faces falling housing prices, a trend which we have been following for months now, as well as weak consumer spending and broad debt troubles, which we will touch on shortly. Stocks in mainland China and Hong Kong declined at the market open on Monday. The MSCI China index slid as much as 1.1% to its lowest since the 1st of June. The offshore yuan weakened about 0.2%. China's 10-year bond yields fell 1 basis point too. The People's Bank of China move was such a surprise that it has even led to some to speculate that perhaps Beijing is purposefully trying to slow the economy in order to wean it off cheap credit, finally accepting short-term pain in the hopes for longer-term stability. Quote, "It looks like policymakers are putting a lot of weight on the banking system's ability to run smoothly. They may want to protect banks' net interest margins, which cutting the LPR can pull down. At the end of the day, you need a healthy banking system to help absorb economic shocks and continue to deleverage the property sector," end quote. US-based Bloomberg also writes today that this decision has left many observers concluding that China will muddle through with targeted help for companies and limited measures to boost sentiment rather than an all-out stimulus plan. Quote, "But bold moves can't be ruled out, particularly if the political risks get too high. After all, she allowed a sudden dismantling of COVID-era mobility restrictions late last year, following spontaneous protests against lockdowns that included calls for his removal," End quote. And yes, the question is, how much economic pain and the resulting political pressure can Beijing weather? And if it's too much, will they blink? Quote, the bottom line is whether they're willing to increase fiscal deficit. At the moment, policymakers are still reluctant, but then maybe the economic reality may change their minds. End quote. And we have indeed seen Beijing, in the face of surging debt, exercise some fiscal restraint. China's budget deficit shrank by more than a third so far this year. Quote, a sign of Beijing's cautious fiscal policy despite the economy's slowdown and a worsening housing slump, end quote, in the words of one analyst. According to Bloomberg calculations based on data published yesterday, Monday, by the Ministry of Finance, the broadest measure of the fiscal gap, the so-called augmented deficit, was 3.3 trillion yuan, $449 billion in the first 7 months of this year, down 37% from the same period in 2022. Total revenue was up 6%, spending was down 4.8%. We note, though, of course, that these are still deficits, and growth is slowing. Meanwhile, we note that some commentators are in favour of this more restrained central bank posture. Quote, I think the People's Bank of China is right to show restraint. Cutting rates would boost effective demand only if high demand were being constrained by high borrowing costs. But there is little demand, and by acting with restraint, the People's Bank of China is acknowledging the limited role for monetary policy in reviving growth. End quote. Indeed, Julian Evarts-Pritchard, chief China economist at Capital Economics, observed today too, quote, hopes for a stimulus-led turnaround in economic activity now largely depend on the prospect of greater fiscal support, end quote, as opposed to support from the People's Bank of China. Others argue that we're just seeing Beijing attempt a more balanced approach. Quote, the signal now is that there will still be policy controls on the property sector, just that they will be optimized. End quote. Now, it is also worth reminding ourselves once again of the great boogeyman Beijing policymakers are afraid of more than slowing economic growth, and what has so far been staying their hand, local fiscal debt, and the systemic risks this poses to the financial system. Today, Chinese financial media outlet Caixin published a special cover story titled, China's Hidden Debt of Local Governments Threatens National Economy. The piece, written by several top China economists and analysts with the nationally respected financial outlet, unpacks the deeply concerning nature of the issue, explaining, quote, after years of rapid growth, the property sector has hit the skids, triggering a liquidity crisis for municipal and provincial borrowers that poses risks to the country's financial system. End quote. The piece observes that more than 80% of local government financing vehicles do not have enough operating cash to cover interest payments on their debt. 80%. According to research by Hua'an Securities Co., by the end of this year, about 2.6 trillion yuan of bonds will come due for over 3,400 local government financing vehicles. To date, no local government financing vehicle has failed to repay a bond, but analysts warn that a default would shake the foundations of the domestic bond market. The market has so far seen local government financing vehicle debt as essentially backed by local governments. Defaults on this debt would be seen as a default by local governments directly. The Caixin piece explains that, quote, exacerbating this crisis is that trillions of dollars of local government borrowings consist of hidden debt. End quote. We remember that the International Monetary Fund estimated these borrowings could range from 30 trillion yuan to more than 70 trillion yuan, $10 trillion. The Caixin piece also frankly argues that many local governments are already facing a liquidity crisis, and the central government knows it. Quote, Caixin learned that the Ministry of Finance launched a comprehensive survey of local governments off-the-books borrowing early in 2023. The results of the survey are yet to be disclosed. Some local governments are unable to pay their debt interest this year, according to a person at a large bank's government business department. From the start of the pandemic, debt repayment has been erratic and has deteriorated further in the second half of last year, especially among provinces in the southwest and northeast regions, the person said. Many local governments have had to borrow to pay salaries of civil servants, while a few governments have delayed salary payments altogether. We have learned from multiple government employees." End quote. If these reports are accurate, it is not hard to see why Beijing would be hesitant to put more fiscal strain on local governments. Okay, that is today's episode of China Update. If you enjoyed the episode, don't forget to hit that like button. Liking, sharing, subscribing are all huge helps for the channel. If you're getting some value from this sort of content and you'd like to help me keep this channel sustainable financially, Patreon and Buy Me a Coffee links are in the description below. This channel relies primarily on subscriber support to keep going. Thank you everybody for watching, thank you for all the support, and I will see you all tomorrow.